Okay. Good afternoon and welcome to the West Yorkshire Pension Fund Members Meeting 2024. The presentations that follow will provide you with information about the investment and administration of the fund in 2023-24 and also highlight current and future activities and goals. A number of member questions submitted ahead of today will be addressed as part of those presentations. There will also be a demonstration of the fund's website for members. West Yorkshire Pension Fund is one of the largest of the regional funds that make up the Local Government Pension Scheme, or LGPS. At 31st of March 2024, West Yorkshire Pension Fund had more than 323,000 members and over 400 active employers across the UK. The fund's largest employers are the 5 West Yorkshire councils: Bradford, Calderdale, Kirklees, Leeds and Wakefield. In addition, West Yorkshire Pension Fund provides shared service administration to 3 other LGPS funds and over 20 fire and rescue authorities. In total, more than 500,000 members and almost 950 active employers. West Yorkshire Pension Fund is unique amongst LGPS funds in having its own investment management team, in addition to being part of the Northern LGPS pool, together with Greater Manchester Pension Fund and Merseyside Pension Fund. For 2023-24, West Yorkshire Pension Fund's assets were valued at a record year-end high of nearly 19.3 billion at 31st of March this year. Last year, the year in question, 2023-24, was a relatively good year for investments, with many stock markets around the globe delivering positive returns, due in part to inflation expectations falling back towards central bank targets and speculation building as to when interest rates may start to reduce. West Yorkshire Pension Fund's provisional investment return for the year was 8.6%, which is materially above the assumption made by the actuary at the 2022 valuation, and the 4th consecutive year of positive returns. West Yorkshire Pension Fund's Managing Director, Euan Millar, and its Chief Investment Officer, Leandros Kalisperas, will provide a more detailed account of the fund's activities and performance. During the year, the West Yorkshire Pension Fund Investment Advisory Panel undertook a strategic asset allocation review and consulted on changes to its investment strategy statement with stakeholders, including fund members. The Investment Advisory Panel also reviewed its investment beliefs and agreed 3 key investment themes that is embedded within its updated investment strategy statement. These are based around the United Nations Sustainable Development Goals. The themes are an increased investment in climate solutions to help meet the fund's 2050 net zero target, sustainable cities and communities to support, for example, investment in sustainable and affordable transport, the building of affordable and energy efficient homes, and retrofitting existing housing stock and developing brownfield sites. Economic growth driving decent work to provide support, greater investment in innovation and infrastructure to address today's challenges and creating better job opportunities. To reinforce its commitment to increased investment in climate solutions, West Yorkshire Pension Fund has made clear it will not use its assets to fund fossil fuel developments. In particular, it will not be lending to oil and gas and coal sector, continue to work with like-minded investors to demand a similar approach from the banking industry. West Yorkshire Pension Fund is currently undertaking a review of our equity holdings in the oil and gas sector. More recently, the fund has made a pioneering investment in Rebalance Earth, the UK's first boutique fund manager entirely focused on nature as an investable asset class. Rebalance Earth finances nature as infrastructure, which provides climate adaptation and resilience for companies, communities and cities across the UK. Looking ahead now, following the general election in July, the new government has launched a pension review, looking at how pension schemes can help drive UK economic growth. In many respects, the LGPS has led the way in this area, with West Yorkshire Pension Fund and its partner funds in the Northern LGPS pool having already made a number of investments that are expected to both provide an attractive return for the pension fund whilst generating social and/or economic benefits. There is also an increasing focus on consolidation and collaboration in order to generate further efficiencies. Arguably, West Yorkshire Pension Fund's most high-profile collaboration is the Northern LGPS Pool's Cllr Direct Infrastructure Partnership. Developed alongside the LPP pool, which now has committed funds of approximately £4 billion and also has the UK's largest defined contribution scheme, Nest, as an investor. During the forthcoming year, we hope to see the new government formally introduce requirements for LGPS funds to report on climate change risks and also to implement the recommendations for the LGPS Scheme Advisory Board's Good Governance Review, which will help ensure best practice across both the investment and administration aspects of operating a LGPS fund. Talking of which, West Yorkshire Pension Fund's administration service continues to perform to a very high standard in a continually challenging environment. The fund is in the process of implementing the much talked about McLeod remedy and is making excellent progress in preparing for the launch of the pensions dashboards. The fund has updated its website to drive an increasingly digital member offering. More on that later. There is also an increasing focus on delivering economies of scale and efficiencies in LGPS administration, and West Yorkshire Pension Fund has demonstrated the benefits of collaboration in its shared service. Administration costs per member were £18.73 in 2023-24. This will once again be one of the lowest costs in the LGPS. However, low cost does not come at the expense of serving members, and reassuringly, West Yorkshire Pension Fund continues to score very highly on quality in the CEM benchmarking studies that we participate in each year. In conclusion, I would like to thank all members of the bodies that provide oversight of West Yorkshire Pension Fund for their valuable contributions over the past year. I would also like to thank officers, advisors, fund members and employers for their continued support of the fund. I will now hand over to Managing Director of the West Yorkshire Pension Fund, Euan Millar.
Thank you very much, Councillor Thornton, and good afternoon, West Yorkshire Pension Fund members. It's the second year I've had the privilege of presenting at this AGM. I'm going to start with elaborating on a couple of the facts and figures we've got up on the slide in front of us. Councillor Thornton touched on some of these in his introductory remarks. Ones I'd like to highlight in particular on the right-hand side, the average annual pension in payment. So this is just over £5,000 for pensioner members and £3,200 for dependent members. So these are the spouses of late pensioners. Often the public sector pension schemes get referred to as gold-plated, but I think you would agree these figures are relatively modest. And it's important because there's a lot of part-time members in the LGPS and a lot of relatively modest earners. So I think it's quite often a sort of misrepresentation of public sector pensions and the LGPS in the media at times. So I thought it was important to highlight these figures. Another figure just below that you see is the West Yorkshire Pension Fund staff numbers. So 208 full-time equivalent. So it's a really complicated job administering the West Yorkshire Pension Fund and investing the assets, and takes quite a lot of staff to do it. We are, of course, based in Bradford. This slide summarises the value of the West Yorkshire Pension Fund assets and how it has generally increased over time. As Councillor Thornton mentioned, at the year end, it stood at £19.35 billion. We have crept over the £20 billion mark at various points. I'm not quite sure what it stands at today. It's probably quite close to the £20 billion mark. But that's quite an important milestone, I think, for us to cross. I mentioned on the right-hand side there, they do an annual paper that's released, the world's 300 largest pension funds. And West Yorkshire Pension Fund does feature in this list. We were 241st last year. We're at 249th this year. I don't think it's anything we've done wrong why we've fallen slightly. Each of these pension funds will have different reporting year ends, which will make a difference. And also exchange rates will come into play because obviously these funds are based all around the world. Quite topical given the American election that took place yesterday, but the two funds that are immediately above us, just for interest, is the Kentucky Teachers Pension Fund and the Idaho Public Employees Pension Fund. And the fund immediately below us is Daimler in Germany. So always great insight, these annual surveys of these top 300. I do hope we stay in the top 300, just so it gives me the opportunity to quote such facts at this meeting. I'm summarising some key issues from 23-24 year. I mentioned administration challenges firstly. There are always challenges in pensions administration. There is never a quiet time. But it does feel like the last few years have been particularly busy. A couple of things I will come on to mention later on is McLeod remedy and the introduction of pensions dashboards. UK economy has obviously been very high profile, especially with the budget that took place last week. For 2 or 3 years now, there's also been issues around local authority finances. There's been some quite high profile financial difficulties experienced by some local authorities. And I think all local authorities are under financial pressure, which clearly has an impact on the LGPS. Global conflicts. The two most high profile are Ukraine and the Middle East, and we will come on to talk about those slightly later on. They again have an impact, particularly in investments and upcoming elections. So at the start of the year, I think we were looking forward and saying, you know, a large proportion of the world's population is actually going to the polls this year. The big elections, if they're not all complete, are now largely complete following America last night. I did write these slides, of course, before I knew the result of the American election. But there's also the UK election, which you will know took place in July, and there's important implications for that. I will come into further detail on that later on. And some local issues for West Yorkshire Pension Fund. We run shared service administration, so West Yorkshire Pension Fund staff carry out the pension administration for 3 other LGPS funds. That's Lincolnshire and 2 London boroughs, Hounslow and Barnet. And we also administer around half of the fire authorities in the UK. So the fire scheme, it doesn't have assets, but it is locally administered. So each fire authority has to carry out pensions administration of the firefighters' pension scheme. Second bullet point, I talk about automation. So for efficiency, some fairly commonplace admin tasks we're looking to mechanise. For example, deferred benefits. So, for example, when a member leaves active service, not when they're retiring, when they're leaving to perhaps get another job, we would receive a final pay figure and confirmation from their employer of the date that they left. We would then send out to that member what their deferred pension in West Yorkshire Pension Fund is that they've earned from that employment. So, for example, that is a task that we've recently mechanised. As soon as we get that pay information and that service information, a letter can automatically go out from the member without any sort of human interaction from West Yorkshire Pension Fund staff. So it's really important to kind of mechanise and automate as many of these sorts of core processes as we can and allow staff time to focus on the sort of complex and strategic matters. This is, of course, with a focus on ensuring we continue to deliver excellent value for money. The funding position continues to be strong. LGPS valuations are a little bit like painting the fourth bridge. As soon as you finish one, you go back to starting the next coat. So we've gone from implementing the outcomes of the 2022 valuation to looking ahead to how we go about undertaking the 2025 actuarial valuation process. We've still got 5 months to go, but hopefully it should be relatively positive, the 2025 valuation process, and may result in slightly reduced contribution rates for employers. The member contribution rates are, of course, fixed in the regulations. And finally, something Leandros will cover in much more detail is our new strategic asset allocation and embedding our investment beliefs. Something that I did mention in this meeting last year and continues to be an issue is the financial reporting difficulties in local government. So there was quite significant delays in 2021-22 accounts for local authorities. They've now, for the most part, I think, been completed. It did have a knock-on impact on the 2022-23 accounts. Government has announced a backstop date by which these 2022-23 accounts need to be completed. That is in December. but again, it will knock on the timescales for the 23-24 accounts. For West Yorkshire Pension Fund, our accounts, audit, etc., have been completed, but for technical reasons, we can't formally publish our annual report and publish our accounts until the council has done the same and followed through its process to completion. Also worth noticing here that there was some new accounting guidance that was released in the springtime, which did apply for the 23-24 accounting year. Didn't give funds much time to take stock of this guidance and implement it. So it's on a best endeavours basis for 23-24, and it will be requirements for 24-25. Some new key performance indicators funds are required to disclose, and there's also sorts of presentation changes to the annual accounts designed to make them easier for users to read and understand. This next slide talks about membership trends. Hopefully you can read the smallish font on the chart. The blue bars to the left are membership in 2006. So we split it between active members, deferred members. These are members who are no longer in active service, accruing benefits with their employment but haven't retired yet, and pensioner members on the right-hand side. The recent trends, so going from 2023 to 2024, we've actually seen a slight fall in active members. This might be the first year where we have seen a substantive fall in active members. I suspect it is largely due to reduction in budgets at local authorities. Leavers at local authorities quite often aren't being replaced. And of course, when members leave, they either become a deferred member or a pensioner member in general. So you would expect to see an increase in deferred members and pensioner members if you see a reduction in active members, which is, of course, what we're seeing. I've not checked the figures, but I suspect it is still the case that we get more new retirements than we do get members passing away. So you would expect the pensioner figure to continue increasing year on year. Just to point out, some members may have more than one record. We are doing some work. This is one of the tasks that we're trying to automate to link records together where members do have more than one record, but sometimes members have more than one local government employment over their career, so may have more than one separate pension record. We would count as two separate members or three separate members if they have three records in these statistics. This next slide talks about fund employers. They broadly break down into two categories, fund employers, so either scheduled bodies or admission bodies. Examples of scheduled bodies are local authorities, the councils, academy schools, further education colleges, and some universities. It depends sort of what tranche of universities they are. These employers, these scheduled bodies, are required by the regulations to offer membership of the LGPS to their eligible members. So, for example, universities would not offer eligible membership of the LGPS to teachers, but non-teaching staff in those universities would be offered membership of the LGPS. Same with schools. Teaching staff would go to the teachers' pension scheme, and non-teaching staff would be offered membership of the LGPS. Admission bodies have a degree of choice as to whether they offer membership of the scheme to their employees. I quote some examples there. So entities that are scheduled bodies, if they outsource a contract, for example, the school might outsource a cleaning contract, that cleaning contractor would typically join the LGPS as an admission body. Some employment law might apply. So if a member was a member of the LGPS when they were employed by the school, if their employment is transferred to a contractor, they would generally get to retain their LGPS membership via that admission agreement that the contractor signs with the fund. Membership numbers are quoted at the bottom of the slide, have been fairly stable of late. So we have around just over 400 active employers in the fund at the year end. There is a little bit of churn of employers during the year, so we will get new employers joining. At certain periods of time, we might get a lot of academy schools being created, which are a new employer in the fund. But most employers, I would say, are these contractors where a scheduled body, be it a council or a school, outsources a contract. We would admit that employer. And also contracts come to the end of their life, and then that employer ceases to be an active employer in the fund. So that's why we've got about 400 employers, and we have a churn of roughly 40 a year that we've seen. My bottom comment is that employer profiles and objectives are becoming increasingly diverse. So what I mean by this is academy schools are relatively recent. Employers in the LGPS, they will have typically, most of their members would be active members. There would have very few pensioners, whereas councils that have been in the fund for an awful long time, they will have more pensioner members than they will have active members. And the reason it matters, it's not really an issue for members, it's more an issue for employers, is that these employers can be more sensitive to investment returns depending on their membership profile. So inflation. So inflation was a really hot topic at this time last year. As members will be aware, we got a spike of inflation pretty soon after the initial COVID pandemic. It peaked at around above 10%, might even got up to 12-13% levels briefly before falling. And it's actually fallen right back to about 1.7% at the moment. So the most recent inflation figure was the September inflation figure. We use the consumer price inflation figure as the relevant measure, which government typically uses for most things these days. And that's actually below the Bank of England's targets. The Bank of England's target is for a CPI figure of 2%. The Bank of England increased interest rates many times to try and combat inflation, and has actually pretty much succeeded in meeting its target of getting back towards that 2% figure. Markets have expectations of inflation. I think we might expect inflation to rise again slightly. There's things that have quite a big impact, like the fuel price caps. Oil prices are another big factor. But I think we might see inflation rise slightly from that 1.7% over the next year. The September figure is quite relevant because it is that September figure that is used to increase the pensions in payment in the LGPS and increase the deferred pensions. So the pensioner members will get, in all likelihood, a 1.7% increase in their pension from April next year. I think the increase actually applies, I think it's from the Monday after the end of the start of the new tax year. So your April pension will not receive the full increase. The full increase will come through in May. You'll get a part increase in April. I also used the word should increase by 1.7%, I think, earlier. Government needs to confirm in regulations what the increase is going to be. In every year since I've sort of followed this process, it has confirmed that September CPI figure is the increase, apart from 1 year where I think inflation might have been negative and it used 0. So in all likelihood, it will be that 1.7% that's used to increase the pensions. Interestingly, this year, the state pension will increase by more than the LGPS, and that's due to something called the triple lock, which I'm sure you've heard mentioned. So the triple lock commits to increasing the state pension by the higher of national average earnings increases, CPI, and 2.5%. And that national average earning increase was 4.1% in the most recent year that they measure it. And I guess the reason that's quite a lot higher than CPI is probably because there's a little bit of a lag there. Wage settlements, I suppose, are negotiated slightly after inflation figures are known. They're almost sort of catching up with inflation. So for this year, we're seeing the state pension increase by quite a lot more than the LGPS. So important point to note there. This slide summarises investment markets over the year. Generally positive on balance. So I think most LGPS funds and most pension funds in general probably saw positive returns over the 23-24 year. Apologies, it's a little bit hard to read the text. The top couple of boxes, the sort of blue purple colours, are equities. So global equity had an extremely good year, returned over 16%. And there was driven by a large extent by the performance of some big American tech stocks. You will have all have heard the Magnificent Seven talked about. So these are really big really big stocks in America. Fixed interest is the green columns further below. A bit of a mixed bag for performance for fixed interest. There's a big currency effect. So if you're looking at investing in bonds overseas, a lot of the return, unless you hedge the currency, will depend on how that currency is performed against the pound. One of the reasons that there's some positive performance and some negative performance. I think the pound had a relatively strong year in 23-24. And then the bottom few boxes, the sort of yellows and brown colours, are private markets. So these are things like property and private equity. They had a positive year, but less positive than public market equities. The main reason for this is probably interest rates being relatively elevated during the year. It's not a hard and fast rule, but a general rule of thumb is private markets tend to do better than public markets when interest rates are low. There's a bit of a lag effect as well. I think the increase in interest rates sort of catches up with private markets 6-12 months later because there's a sort of lag in the valuations. The next few slides highlight some figures from the West Yorkshire Pension Fund accounts. It's a bit analogous to sort of a company profit and loss account. The concept of profit doesn't really exist in pension funds, but it's a similar sort of concept. We have contribution income, so that top line, it's what we receive in contributions both from employers and from members. That's going to be broken down in a bit more detail on a subsequent slide. You'll have noticed that's relatively stable over the year. I mentioned earlier that our active membership has fallen slightly. You would expect that to reduce the contributions we receive. But I suppose pay will have probably increased slightly due to the inflation that we mentioned. So that's relatively steady. Benefits payable has increased by a lot. It's gone up from 656 million to nearly 740 million. That is largely the impact of the 10% pension increase that was applied in April 2023. Management costs, we will talk about in a bit of detail in a couple of slides. They've been fairly steady and are very small in comparison to benefits paid. And then the next row down, net additions, that's just the sum of the three figures above. Investment and other income. So this is the investments we receive from our assets. I mentioned earlier, we've got roughly 20 billion of assets. Many of these assets are income generating. Our income has gone up from 495 million pounds to 566 million pounds, which means that we have a positive balance going into the fund of 400 million pounds. So we've got outgo in terms of pensions paid, 740 million, which is higher than the contributions received, but that difference is more than made up by the investment income we receive. So cash flow position very healthy, relatively stable over the year. So it's actually dropped slightly from nearly 410 million to 400 million. I think it might be a trend that continues to a certain extent. As we mentioned earlier, the number of pensioner members is greater than the number of active members now. And you have this 20 billion pounds for a reason. You wouldn't have a fund if you didn't expect at some point in time your outgoings to exceed your money coming in. So that's the whole reason we build up a fund to start with. So I wouldn't be surprised if it's the start of a trend where we do see that sort of overall income into the fund reducing slightly, but it's certainly nothing that we need to be concerned about. But it is something we bear in mind when we're looking at investment strategy. And I think West Yorkshire is in a much stronger position than most other LGPS funds in this area also. The row below that, change in market value. So this is the increase in the capital values of our investments over the year. Was quite a strong year, nearly £1 billion increase. Added to the investment income we receive gives you a net increase in the fund's assets of 1.38 billion over the year. And that means that the fund's assets have increased from just under 18 billion to 19.354 billion over the year. The next slide breaks down the contributions in a little bit more detail. Splits the contributions received into employers' contributions and employees' contributions. Employers' contributions tends to be a bit lumpier than employees' contributions. That's because Employers will sometimes make a lump sum payment to us, and we also change the contribution rates every 3 years after the valuations are completed. So the 2024 figure there you will see is the first year after the 2022 valuation has been completed, and you notice there's a drop in employer contributions of about 20 million. I think that's because we've shown an improved funding position at the actuarial valuation. A couple of items at the bottom: non-statutory pensions. So these are pensions awarded in days gone by as a part of redundancy payments for members. They're sort of done as a pay-as-you-go basis. So we recharge the cost of these back to the employer. And then the bottom item is transfers into the fund from other pension schemes. So that was over 45 million for the year. Next slide looks at benefits paid. Majority of benefits that get paid are pensions, so the monthly pension payments, that's nearly 550 million. Also a significant figure for lump sums. So this is on retirement. Members receive a lump sum. There's some flexibility in the level of lump sum that members can take. Also similar to the previous slide, there's two other smaller items. So I mentioned these non-statutory pensions, they get recharged. So the same figure goes out as gets paid in. And then transfer values paid out to other pension schemes is that other figure at the bottom. So that's nearly 30 million for the year. And the next slide, sort of analysing the figures in the accounts, is administration expenses. The accounting guidelines require LGPS funds to break this down into 3 items. So there's pensions administration, so that is largely the wages of the team that administer the pensions and other relevant costs. For example, our software agreements with the firms that provide the administration software. There will also be other IT spend in this area, premises. Then the next line is investment management. I'm going to let Leandros talk briefly about this, but it's slightly harder to predict than pensions administration spend, mainly because it depends to a certain extent on how much we trade. Is one of the important factors in investment management. I don't know, Leandros, if you've got anything to add on this slide.
Just to amplify what the chair said at the beginning, referring to CEM costs. So one of the dual ways to think about West Yorkshire Pension Fund, it is a local authority pension fund reporting its reports and accounts in the statutory way, but it is also an asset owner and asset manager. And in that sense, within the industry, it's typical to think about investment management costs as a basis point of fund. West Yorkshire Pension Fund is now a 20 billion fund. I referred last year to the idea that a typical pension fund of our size and sophistication would roughly have look-through total investment costs of somewhere between 40 and 60 basis points. That figure of 7.1 million is much lower than that because that is only applying the direct internal costs as per the regulation. What the chair referred to is that we have done a piece of work that goes well beyond what's necessary for reports and accounts. And the CM conclusion is that our total look-through basis points, including our private markets activity, is for the last year somewhere in the region of 30 basis points, which is below the average of a scheme of our size. And in my estimation, the lowest not only within the underlying local authority pension funds, but across the pools as well.
The next slide goes into a bit more detail about how our costs compare to other LGPS funds. Government ask funds to submit their cost data on an annual basis. So there's a spreadsheet that the Department for Local Government produce analysing LGPS funds costs and how these compare. We are the second lowest on investment management for the 22-23 year. We're normally the lowest on this, but I suspect there may be some one-off items in another LGPS fund somewhere, which may have meant they were under our costs for this year in question. Administration, we rank the 4th lowest. I think this is a reasonable place to be. You'll notice that administration cost is relatively low, £16.55 per member. Cost is not the be all and end all, I think, in administration. It's all about providing a good service and a good value for money service. So being the lowest cost in administration is maybe not where you want to be. You want to be providing the best value for money service. So I think fourth place on these rankings is quite a good place to be for the fund. We're about £11 per member cheaper than the average in the local government pension scheme. We've got over 300,000 members. So this is about £3 million cheaper than if we were a typical cost of an LGPS fund. We have got some natural scale advantages. We are, I think, the fourth biggest LGPS fund. So you'd expect us to be cheaper than the average, and these figures bear that out. Oversight and governance, we rank second lowest. These figures are quite small. £3.17 per member was the West Yorkshire Pension Fund cost. And if you add these all together, our total costs were £42.68 per member, which is way, way below the local authority average of nearly £309. If you added up this sort of £265 per member, we are below the local authority average. It actually equates to £87 million a year, which is obviously a huge number. As I mentioned before, you would expect us, just by virtue of being a big fund, to be significantly below the average, but it's quite startling, I think, what that equates to at £265 per member across over 300,000 members. So very pleasing, these figures, but there's always more that we can do, and very, very important to maintain the service standards as well. Going to elaborate a little bit more about current administration challenges. There's two things I mentioned before: McLeod remedy and pensions dashboards. I did mention these last year. They're still big issues in the LGPS. McLeod dates back to when they last changed the LGPS significantly in 2014. So it moved from a final salary pension scheme to what's known as a career average pension scheme. And certain protections were put in place for members who were close to retirement. And a court decided subsequently that these protections were unlawful because they only applied to older members. So they were deemed to be age discriminatory. So they needed to undo these protections and offer them to everybody who was in the scheme at a certain time. It's a complicated matter, and the government was a little bit slow, perhaps, in releasing regulations. And then the software providers wanted to see regulations in place before they spent money on upgrading their systems and changing their systems to allow for it. And now we are getting round to the process of actually implementing this remedy. So we're sort of deep in the business of doing this now. It's unlikely to impact many members. I think the act of trying to work out who it impacts is actually bigger than doing the rectification exercise. Making sure you've got the appropriate data to do the calculations is a really big job in itself. I mentioned earlier that we do the administration for firefighters' pension schemes. I would say, if anything, that this is more complicated in the fire scheme than it is in the LGPS, and it is complicated in the LGPS. One good thing about the LGPS is members don't, in general, need to make a choice. We will sort of work out what is better for the member, and we will sort of correct the benefits accordingly. Members in the other public service pension schemes generally do need to make a choice. They need to decide whether they want to go back into the old scheme or they want to stay in the new scheme, but you don't need to worry about that in the LGPS. We take care of that sort of thing for you. I hope not to be talking about McLeod next year. It would be a real achievement, I think, if I could avoid talking about McLeod next year, so fingers crossed. Pensions dashboards, I think I probably will talk about next year, but that might not be such a bad thing. I'm actually getting quite positive on pension dashboards. When they first got announced, I wasn't really sure about it. But the more I hear about pension dashboards, the more positive I am. And just anecdotally, talking to sort of friends about who don't work in the pensions industry, what pension dashboards are going to do, a lot of people have said to me, I think that actually sounds really good. You know, I have lost track where my pensions are. So the idea for pensions dashboards, there's a website, a sort of interface that you can put your details on, and then this dashboard will go away and find where your pensions are held and provide you with a sort of consolidated summary of what pensions you've got. Data protection is obviously very, very important in this field. You know, we need to be very mindful, as do the sort of dashboards program, which is coordinating this around data protection. But all pension schemes, or more or less all pension schemes, need to connect to these dashboards, or the infrastructure that sort of sits behind these dashboards. The dashboards are going to go live in 2026, but different types of pension schemes have been given different what we call staging dates. So the LGPS has been given the staging date of October 2025 for it to be ready to connect to this dashboard infrastructure. So we need to make sure our data is in really, really good shape and in the right format to go into these pension dashboards. I'm going to come on to talk about government's enthusiasm for seeing pension investment in the UK. Well, there was a statistic I saw a couple of weeks ago, which was, I think there was £31 billion in lost pension pots. So these are sort of pension pots that have sort of been sitting there without anybody claiming ownership of them. And I think the dashboard could really help unlock things like pension pots that people have lost track of. And I think that could actually provide, you know, a real economic boost if people could get access to these pension pots and then invest them in the UK economy. So I'm becoming more and more positive about pension dashboards. There will be some unknown consequences. We just don't know when these dashboards go live how it will impact member behaviour, specifically in the LGPS. People might not ring our helpline quite as much because they've got information on the dashboard. But I think more likely is people will see the pension dashboard, go, oh, I've got an LGPS pension, or I need to ask my LGPS pension provider what the implications of this are. So I think we might actually have a sort of surge of activity around the time of the implementation of the dashboard. So we need to be prepared for that. And one good thing about the LGPS is we tend to work quite well together. We work well with other LGPS funds, and we could share knowledge and thinking in this area. So generally a positive story about dashboards. This slide, I mentioned key performance indicators earlier. We tabulate lots and lots of key performance indicators. There might be about 25 or 30 different statistics that we keep a record of. These are the sort of individual processes that we do in our pensions administration function. I've quoted 5 there. The way these key KPIs work is you set yourself a target. That second column from the right is the amount of these processes you need to do within a certain time limit. You'll see the target days figure in the middle there. And it's important to set yourself stretching targets. If you gave yourself too many days, you know, you would always meet this target by and large, and you wouldn't really be striving to improve your service. So it's important to set ambitious target days and ambitious targets for the amount of times you're going to meet these target days. We won't always meet those targets. By setting yourself stretching goals, you won't always meet them. There's an example there for pensions estimates where we've only got 76%, where we wanted 90% of these to be done within the 10-day target, which is disappointing and an area we'll be looking to improve. We tend to focus on actual payments. The most important thing that we make the payments as quick as possible. So you'll notice that top line, payments of pensioners, this is the sort of monthly payments of the pensions. And that bottom item, refund payments, we have been meeting the KPI 100% of the time there, which is really pleasing. So we do focus, if there are times of particular administration pressure, we tend to focus on the actual payments over the estimates, whilst always seeking to meet these KPIs over a period of time. At that point, I'm going to hand over to Leandros for a little bit, and I'm going to present a few slides later on.
Thank you, Euan, and thank you, Chair. Investment performance indicators are cut from many cloths, but I just thought it would be useful to share a couple of ways to think about investment performance. The first and most obvious is that pensions are paid linked to inflation, and in the long run, depending on the actuarial return requirement at the point of a triennial valuation, the investment returns need to beat inflation for the pension fund to feel in a healthy place. When we spoke this time last year, we'd had a significant inflation number for the year, and there were some concerns from members at that time in terms of the shorter term picture. Euan obviously referred last year as well to the fact that investment payments of pension are not dictated by investment returns, they're guaranteed, but it's still a useful way of assessing what the investment office is doing itself to meet the obligations put upon it. The 1 year number is, as you can see, 8.6. Euan referred to market returns more globally, and equities, which is the asset class which most people will be very familiar with, was shown at 16%. So members may ask why our return is half of that. The main reason is that investment offices and strategic asset allocations don't put all their eggs in one basket. So we have 60% roughly of the total fund in equities, and it certainly made up a majority of the returns for that year in question. Returns in private markets, as Euan showed earlier, were quite dull, as they were somewhat in bonds as well. The medium and longer term picture remains as it has done for decades, which is that the investment returns have more than matched inflation plus something, which gives a healthy picture in terms of the solvency overall. Another way that we can look at the performance indicator is actually how, as a CIO, I set the internal teams in terms of what their duties are. In terms of the way that the governance works, the chair of the pension fund with the investment advisory panel set a strategic asset allocation codified in the investment strategy statement, updated every 3 years. And effectively, it is our job to go and meet and, where possible, beat that particular benchmark set by the IAP. We just about met it and slightly beat it over the 1 year period. But again, the greater significance is looking at the medium and longer term picture, where, in total, the investment office that's been running for decades has been able to do the job set by its governance structure. The third way, which isn't, I'm going to call a performance indicator, but I think I referred to it last year as the keeping up with the Joneses indicator, is how does this particular pension plan compare to the other 85 pension plans of similar type in the LGPS? The reason it's more of a fun indicator is that every single pension fund within the LGPS has its own liability structures, its own strategic asset allocations. So this really is apples and pears, but it still says something in terms of whether West Yorkshire Pension Fund is keeping up, and if not, why, and so on. So it's a useful discipline to share. In terms of the 3 year number there, that brackets 15 means that we're in the top quintile in terms of performance, which is obviously good to see. It's been somewhat helped, that 3 year number, by what happened with inflation at times in the last 3 years, and the impact of that on UK equities, which actually had a very strong period when other markets were suffering. And that speaks to a more general point, which I'll come to on the next slide, in terms of our asset allocation more generally. When we spoke in November last year, I referred to the fact that following the close of the previous triennial valuation, we proposed and agreed with the IAP a new investment strategy statement set of policy weights and benchmarks. At the time of November, I had just started to instruct the internal teams in terms of some of the transitions towards moving towards the new active weights that were within the new benchmark. But I'll highlight just something in terms of structure first. If people look at the top few lines, you can see that UK, North America, and the rest of developed markets are all set in the new investment strategy statement at 18%. This is quite a difference to the previous version of the investment strategy statement, where the figures for the UK and North America were 35% and 8% respectively. It's quite a significant shift from a CIO's perspective in terms of transition. What it reflected was an appropriate recognition that the UK percentage within global markets has significantly reduced over a multi-year period, and we had to reflect that somewhat in the policy statements that we have. It is true to say, however, that on a look-through basis in terms of the total fund and as reflected back to government, West Yorkshire Pension Fund has almost half of the total fund in UK markets of one sort or another. In terms of the transitions that did take place in the latter half of this fiscal year, there was some moderate reduction in listed UK equities to fund the increase in the investment opportunities aligned with the new investment beliefs, which we'll come on to in a moment. And there is the beginnings of a closing of the historical underweights to property and fixed income. I'll briefly touch upon this slide. I did go through it last year, but it's worth reaffirming and in line with the chair's opening statements. There are generally two types of investment beliefs as far as my world looks at it. There's investment beliefs in relation to the guts of actually how do you manage a pension fund of this size. And for West Yorkshire Pension Fund, it's clear that there's a long-term investment horizon. We believe in equity risk. We haven't gone down the de-risking strategies of corporate DB over the last 15 years. We've maintained a very healthy and high allocation to equities, both public and private. And we believe in the value of in-house investment management, both from a cost perspective, as shown in earlier slides, but also in terms of investment culture and connection with the locality. The bit that we needed to improve upon was investment beliefs that effectively would be set by the investment advisory panel, which the chair referred to. And at the end of last year and into the beginning of this year, as the chair has already noted, there were 3 themes coming from the UN Sustainable Development Goals, which were climate solutions, sustainable cities, and economic growth. And I just want to touch on the next couple of slides in terms of some of the activities we've been doing in that regard. So the title of this slide is New Alternatives Mandate. So as a result of the investment belief set, I set internally a new mandate for Darren Ward and his team to go about implementing those preferences that had been set by the investment advisory panel. So on the left, you can effectively see in pounds and millions terms how that new alternatives mandate is linked to those UN Sustainable Development Goals. This is very early stages. So there are certainly many aspects within the current alternatives program that do not directly link to those investment beliefs. You have to start somewhere and show intentionality and strategic intentionality, and we are certainly doing that. In terms of the things on the right, those are opportunities and investments within each of the 3 areas that the investment advisory panel have targeted us with implementing. And there's one particular case study which I'm pleased that the chair noted in the introduction, which I will just use as a case study, which is what I believe to be quite a pioneering and innovative direct investment in Rebalance Earth. This was picked up in both the local news in West Yorkshire, but also the national news in the Financial Times. And I think the reason that it was picked up in both local and national publications was the interest that a local pension fund was willing to make a very direct, high-risk investment in a UK startup that was interested in nature restoration, which is a new and emerging asset class. So most of the time, what one hears is that pension funds have a low risk appetite, that they are cautious and conservative investors. And of course, we are a diversified, very prudently managed investment fund, as you would imagine. However, if we are going to implement on the investment belief set by our investment advisory panel, we have to show the courage to actually invest in some of those high-risk entrepreneurial opportunities that could change the world in terms of some of the objectives that have been set. Rebalance Earth, as the chair noted, is a startup asset manager with a singular focus on nature restoration In the world of sustainable investment, I will broadly and oversimplify, there are things that are sustainable, which have some impact, and there are things which are simply nature positive. This falls into the latter and more impactful category of attempting to restore nature. You'll have all heard about the sort of 70% loss of biodiversity that has taken place over the last 50 years. This is clearly only a tiny thing in the direction of trying to improve upon that. The essence of this particular strategy for those interested is that it is clear now that corporates themselves, both voluntarily and perhaps by statute, will have to start paying for the externalities that they have. And what Rebalance Earth is looking to do is develop projects which corporates will then pay for on an inflation-linked basis, therefore giving healthy returns to our members and also doing something good for the planet. Our ESG activity and stewardship is something that is often asked about by our members, so it is worth spending a few moments on that. ESG stands for environmental, social, and governance factors. Those three factors are somewhat different in terms of the implications on individual companies. You can see there what we've said, which is that the Investment Office always endeavours to understand the ESG challenges facing the companies in which we invest, and we have different types of engagement depending on the issue at stake. If I just pick a couple of examples, West Yorkshire Pension Fund co-filed a resolution earlier this year with 19 institutional investors, which was organised by a lobbying group called Share Action. And that was in relation to Barclays and their financing of oil and gas activities. The chair noted at the beginning that West Yorkshire Pension Fund has no interest in lending to companies that will continue to finance oil and gas new activities. And this resolution was our way of saying to Barclays that we wanted it to change its behaviour in terms of its lending practices. In this particular case, we did it in such a way that we were able to withdraw the resolution because Barclays decided to act, and that showed a sense of stick and carrot with respect to our engagement. The other one that I'll pick up is the large Norwegian energy giant Equinor, where we co-led a resolution as we believe its climate transition plan, which includes a significant amount of new gas production, was inconsistent with the Paris-aligned targets that West Yorkshire Pension Fund has committed to. As many of members will know, just because we vote in favour of enhanced engagement by companies does not mean we win those votes. Most votes are lost because if the majority of investors may not take the same care and attention in terms of their engagement strategy and voting strategy as we do, but it's still very important that we try and exert our influence as best we can. I won't spend a long time on this slide other than to note that our stewardship doesn't just end with what we do with the investee companies that we invest in. We collaborate with a number of important groups. You will, some members will know some of those groups, certainly in the ones in relation to climate. But I will just touch upon one other one, which is in relation to antimicrobial resistance, which is a systemic risk to investment portfolios. So we have publicly endorsed FAIR's IAMR public investor statement, stressing our concern around this, both to economic stability and to broader society. And this just gives one example of where ESG is not all about climate change, important though that particular issue is, and an issue that we will turn to now. There were a number of questions from members, but it is fair to say that the majority of them, if one grouped them together, were in relation to two subjects. One was climate change and one was Palestine. So the broad question that members have asked is, why is my pension fund invested in fossil fuel companies? And there are a number of answers to that particular question. The first, and as reaffirmed as part of CBMDC's administering authority role for the pension fund, is that West Yorkshire Pension Fund simply has a fiduciary duty to deliver the best net investment return for an acceptable level of risk. There is, of course, interesting work to consider what acceptable level of risk means and whether some of the companies that we are invested in actually pose themselves a systemic level of risk. But that's the first point to make. The second is that we have committed for a long time now not to invest in thermal coal miners and have made a net zero commitment to fully decarbonise the portfolio by 2050, which means that in effect we are looking to not be invested in what we now consider to be fossil fuel companies by that period. We actively engage with large emitters and we do use our power as a shareholder. We have on many occasions voted against management that fail to adapt or don't show the right transition plan. But it is true to say that West Yorkshire Pension Fund has had further work to do, and that is something that Euan and I have felt is very important since we both joined. And we have worked very, very hard over the last 6 months with a specialist consultant to strengthen our engagement process. This particular paper and report will be being discussed at our investment advisory panel tomorrow, but without breaching confidences of what is a private meeting. It certainly will discuss introducing milestones that companies need to demonstrate their journeys to net zero, because if they don't, then we have to reserve the right to divest them. The second question that people have raised, less in terms of proportion of members to climate change, but still important, was the question of sorts of, is my pension fund being used to subjugate the people of Palestine? So part of the answer to that is as follows. In 2020, the Human Rights Council of the United Nations published a report identifying 112 companies involved in specific activities in the occupied Palestinian territory. West Yorkshire Pension Fund does not currently have holdings in any of those companies, and we have reaffirmed that at the most recent Administering Authority Council meeting. That said, we do acknowledge that West Yorkshire Pension Fund is invested in several multinational companies that operate in Israel, but we do not currently believe that that activity of those companies is harming the people of Palestine or Gaza directly. In relation to BAE Systems, we are invested. It's a company that's within the benchmark that we manage to. It does not make direct sales to Israel, but it is something of an ongoing discussion. And as recently as this morning, in discussing with our responsible engagement manager, he was saying that he was taking a closer look at that particular company. In terms of the sale of weapons, it's tightly controlled, and companies operating in the sector are required to have explicit government approval to gain export licenses. So we would never do anything that could be against the UK government's own policy in that regard.
Thank you, Leandros. I mentioned elections earlier, so you will all be aware that we had a general election in the UK. I think it was in early July, and a Labour government was elected. The key people in the Labour Party in terms of the LGPS are on the left-hand side there in the pictures. I'm sure you know who the man at the top is, and probably on the bottom left as well. In the centre at the bottom is Emma Reynolds, who is the pensions minister, and bottom right is Jim McMahon, who is the minister in charge of local government finance, the reports to Angela Rayner. Largely consistent messaging to the previous government in terms of pensions. So this government can see the benefits of consolidation, so having bigger pension funds, which they believe will be more efficient. And I think there was a degree of sort of collaboration, sort of passing over from one administration to the next in this area. Pensions has always been quite good in sort of joint working between the political parties, so we didn't notice a big change of approach. We had the budget last week. There was lots of rumours circulating for several months leading up to the budget, as there could be quite significant changes on pensions. So there was rumours around, could the tax-free lump sum be reduced or even done away with altogether? Might we see additional national insurance contributions be paid on employer pension contributions? As it turned out, there was relatively little change from the LGPS coming out of the budget. There was quite a complicated thing around overseas transfer payments, so increasing the number of countries where there may be a charge if you transfer your pension to. It's a very, very complicated area which members should be taking detailed financial advice on anyway if they're contemplating it. And the only other thing is around inheritance tax, and this wasn't something announced in the budget speech. It was something in the document that accompanies the budget, where the detail can be found. So you may have seen the announcement that defined contribution pensions that haven't been put into payment yet, inheritance tax will become due on those from 2027. I think there's also going to be a consultation in the LGPS around inheritance tax on what we call death grants. So these are where less than 10 years pension payments have been made after retirement and the balance gets paid as a lump sum on death, or where a member dies before retirement if there's a lump sum due. So I understand there's going to be a consultation on that subject in the LGPS. Other thing to draw your attention to that's an announcement of the incoming Labour government is the National Wealth Fund. It's been set up by sort of rebadging something that already existed, the National Infrastructure Bank, and it's about drawing in sort of capital from around the world to invest in certain UK projects. And I think there'll be a particular focus on green energy, some big green energy investments done by this National Wealth Fund. So it's something that we're supportive of, I think, and keen to link in with where possible. Something else that was announced by the government was something called pensions review. Going to be done in stages. The first stage of the pensions review is focused on the LGPS and what's known as trust-based defined contribution schemes. So these are big master trusts. So quite often employers, rather than set up their own defined contribution scheme, join a sort of collective defined contribution scheme with lots of other employers. So the most famous example of it is something called Nest, which is a sort of government-owned DC scheme. And the reason these types of pension schemes are on the first stage of the review is they're arguably the most able to invest in the UK. The government seems very keen to get more pension fund investment in what they call productive finance in the UK. So I think this broadly equates to private market investments like infrastructure and property, for example, rather than just the UK stock market. A couple of questions which I've got on the bullet points there. Can this be facilitated in the LGPS via the existing pooling model? Pooling is something we will have talked about before, but my next slide will refresh members' minds on what pooling is all about. And is further scale a help or hindrance to this objective investing in UK public finance? A particularly worthwhile thing I think that many LGPS funds do is invest locally. So invest in projects in West Yorkshire in our case. You could argue, I think, that it might actually be harder to invest locally if the fund was to get bigger. If you were a £100 billion fund rather than a £20 billion fund, and your area expands, so it would cover much of the north of England, say, rather than just West Yorkshire, it might actually be more difficult to invest locally. I think bigger projects, which you would tend to do if you're a bigger pool of money, are more likely to be based in London or the southeast of England. And the amount of projects that any organisation can run at one time as well is also limited by the resources they have available. Many of these local investments are quite small, so arguably bigger pools of capital might actually be less likely to make these local investments. There was something called a call for evidence ran for government. quite a quick turnaround. It only ran for 3 weeks, 4th to 25th of September. Both West Yorkshire Pension Fund and the Northern LGPS pool, which we are part of, submitted responses and made some of these points I've made above. We might be hearing some news on where this pension review is going as soon as the 14th of November. There's been some headlines circulating in the press. So the Sunday Times had an article about it at the weekend. And I think there's a little bit of misinformation in places. I think the journalism can be slightly sloppy at times. So I think it referred to the Chancellor wanting to create a single super fund. And a single super fund in the LGPS, I would take to mean merging all the 86 regional funds in England and Wales, which is not something I think you would want to do, because we've got 86 administration teams by and large, ignoring some shared service arrangements. And we know from our experience that merging administration functions is very, very difficult, time consuming, and will take up a lot of committee time, a lot of government's budget. So if you're actually wanting pensions to invest more in the UK, I would not go about it by merging 80 pension administration functions. So I doubt that that is what actually is being planned by the Chancellor. I don't know what the outcomes or the direction of travel of the pensions review is going to be, but I would be surprised if it was a merger of all the 86 LGPS into a single fund. I think it is more likely to focus on investments. In terms of the Northern LGPS, so as a recap, this is a local government investment pool. The 86 funds have been told for some years now, it dates back to about 2015 or 2016, to work with each other to create larger pools of capital, which can reduce costs, be more efficient, more able to invest in private markets. So the pool that's been formed by West Yorkshire Pension Fund is with Merseyside Pension Fund and Greater Manchester Pension Fund, called the Northern LGPS pool. Important to note that we're doing many of the things that government would like the LGPS to be doing. So around 43% of the pool's assets, which equates to about £26 billion at the year end, is invested in the UK. Around £9 billion of this is in private markets, this productive finance. Within that £9 billion is £2 billion in something called the Cllr direct infrastructure vehicle. So the chair mentioned in his introduction, this is a joint venture between the Northern LGPS pool and one of the other pools called LPP. And these are net asset values we've quoted there. The way these private markets work is you have to commit to these investments, and then the manager draws down the money over a period of time. So this undrawn commitments we've got is actually £6 billion. So this figure we've got invested in this productive finance is set to increase over the next few years as well. Around 30%, 18 billion of the pool's assets is internally managed. As Leandros will have mentioned, West Yorkshire Pension Fund is very proud of its internal management. So most of these internally managed assets are within West Yorkshire Pension Fund. We do have a long history of innovative local investment, driving regional economic growth. That's also something that Greater Manchester Pension Fund and Merseyside Pension Fund have been very strong on. And the pool has delivered big cost savings, despite the fact I think we probably had the least cost to save to start with. I think our cost savings are probably the best of all the local government pools, and they stand over the sort of 8 or 9 years that these pools have been going at £217 million. Much of these cost savings are from this Cllr direct infrastructure vehicle. Investing directly produces big cost savings because typically when you invest through private market managers, you need to pay fees on the undrawn commitments, whereas if you invest directly, you don't need to do so. So that's created big savings. And Leandros mentioned in his earlier piece that we benchmark our investment costs, and they are very competitive against not just peers in the UK, but also global peers. So one final slide before I pass over to Stuart. Some key takeaways for members. So the pensions in payment are set by regulations, not affected by movements in stock markets, investment returns, or future changes to the LGPS. For example, anything that might come out of the pensions review. Very important to emphasise this. As you will have picked up earlier, inflation-linked benefits in the LGPS likely to increase by 1.7%. in April, I should say April 25, I now realise. State pension, if you are receiving the state pension, will increase by more than this. And West Yorkshire Pension Fund is financially very sound. As I hope I've demonstrated, it's got positive cash flow and a surplus of assets over liabilities. So at that point, I'd like to pass over to Stuart, who is our head of communications, who's going to talk through some things like our new website.
Thank you very much. And thank you, everybody that's going to hang on just to hear me run through some nice, easy, good news stories. So, yes, I'm Stuart Duncombe. I manage the communications team. So we've existed for a few years now in a bit of a reorganisation. We used to be part of a broader organisation or team within WYPF. So originally we were quite small, just two of us, both with pensions backgrounds rather than technical digital backgrounds. We have now grown to a whopping 4 people, 2 of which now have those stronger technical digital backgrounds to them. And we were formed with a very particular remit of work to be done, which was to look at our online experiences and to work to improve them. So what are online experiences then that we're looking at? It's things like websites, it's those transactional spaces where you log in, so My Pension, as you currently see. And it's also things like how we communicate with you digitally in emails and things like that. So we started off with perhaps the most visible thing that everybody who kind of touches WYPF digitally interfaces with, that's the website. So hopefully you can see an image there of our now old website. So there was some good things there. You know, there was lots and lots of information. And for a lot of people, it was familiar. It had been in place for a long time in that structure since around the 2013 point. So people kind of knew where stuff was if they'd spent time on it. But that brings with it some not so good things as well. It was built on some pretty old technology, which in essence gave it a certain look that wasn't particularly modern, wasn't particularly attractive. It was quite technical in nature to navigate around as well, which made it difficult to find the information. Although it was there, you might not see it. And then now we're in a world of a lot of people using mobile technology, their phones or small tablets, to access these digital spaces. And it wasn't natively a good experience for users. So we set about looking at what we could do to improve that. So we had some challenges there that we wanted to face. Lots of mobile use, quite a wide group of people who actually want to use this website. So not only do we have you, our WYPF members, but even that is quite a wide group of people. We have people paying in, you have pensioners, you have people who've left 10, 20 years ago who are looking to find their deferred benefits. But we also have 3 other local government pension funds, Lincolnshire, Hounslow and Barnet, who all have administration shared service with us. So we need to communicate with those people equally. And we do fire pensions administration as well for 24 authorities. There's a really big use case there before we even start looking at making sure we have somewhere good to house Leandros' investments work and careers and all of those sorts of things. So it was a big challenge and a big piece of work to do. So the development process, which we went through, had 3 very key stages. In principle, quite simple. We went through a research phase. So what did that look like? We actually sent out surveys to about 40,000 members. Hopefully, maybe a few people watching this are people that responded. And if you were, you would have seen the opportunity there to have volunteered, to have joined a panel of people to be on a focus group for us. We also did things like competitive analysis. What do other pension funds do? How do they look? What do other financial sector organisations do? So we tipped all of that research into doing some early design work. And then we ran that through a cycle of design and test, linking back into those people who volunteered for our member focus groups. So that led us down a path of building some designs, testing those out with people and seeing how they look. And in those focus groups, really taking an opportunity to dive and delve in. What do members really want a website to deliver for them? So lots of things we knew from the survey, and some things we instinctively could probably identify ourselves. But there's some really interesting things as well. A lot of people visiting the site are actually there because they want to very quickly and easily access the transactional services, so My Pension. Another thing, a theme that comes out, as much as the four of us sat here, pensions can be a passion. For a lot of our members, it isn't. And actually, people want to get in, find out something very quickly, and then leave and get on with their day and do something different. So we need to facilitate that type of interaction as well. And also, although I've said before here, actually, it had some great information previously, it was very interesting to actually talk to users of the website to see what information it didn't have that we wouldn't necessarily consider valuable or have even considered something we would want to be showing to people. So that process was very iterative. And at the end of that, we ended up with some very core concept points for the website. We wanted to route that navigation process in a very semantic, I have an intention, I know where I can go through the words on the page sort of style for it. And we needed to give people the ability to find information through those intentions rather than having to understand what pensions really, what the words all mean always. Some of them are technical in nature anyway. And so people to get to that information easily. And we also had to do things around making sure if you wanted to find a bit more about how your pension fund itself, whether it's West Yorkshire Pension Fund or one of our shared service funds, Lincolnshire or Barnes or Hounslow, there was somewhere easy to go and find that information as well. And perhaps one of the loudest, clearest messages which came through was people wanted it to look nice, which is a very sort of personal word, but what does that mean? So they wanted it to be modern, clean, friendly, bright. So all these things. So we tipped all of that into that iterative piece. And then in September, we were very proud to launch a new website, taking in all of that feedback from all of you people who helped us on that journey. Very much based around, if you're a local government member or a fire member, you then drive into an experience that talks to you in very easy words. So if you have an intention of, I'm receiving a pension and I want to find out something, you go into there and you would find that, and it should be an easy process. In doing that, though, we did identify that tipping a whole pension scheme into 6 or 7 semantic journeys is rather difficult. So we've also created a side piece there called the Knowledge Hub. So that collects all of the events we hold, where newsletters are, forms, guides you might want to see, and also then some bigger topics in more detail. So for a lot of people, if you want that quick in and out interaction with the site, you'll get the information you want from those journeys. But if you wanted to find out more about, for example, transferring out, then there is a bigger topic there that you can go and delve into. It's all about the risks and the things to be aware of, making yourself scam smart, all of these detailed information that if you just want to have a quick read, you don't need to know, but the information is there if you want to go a bit further. So that was what that website journey looked like, and it was a fun piece for us, and I hope any of you that have had the opportunity to look at the website have found it to be a much improved experience. We would also love your feedback. The next slide I'll show you will have the Commons email address there. If you have something you would like to say, please do. And I will just mention there'll be a broader feedback survey coming out to everybody at the end of this meeting about this meeting. So your thoughts and views would be appreciated. It would be rather remiss of me as well, while I have a captive audience, not to advertise some of the sessions we hold for members as well. I'm talking really to our active paying in members at the moment, rather than our deferred or pensioner members here. But there is lots of support to help you understand not only the local government pension scheme, but also what retirement looks like and how you can prepare for it as well, and some of the wider financial well-being pieces that interact with your pension as well. So if you don't feel like you're fully in control of your pension future, or you just want to find out a bit more, please do visit our pages and have a look at those events. So I talked at the very start of my piece around online experiences, and where we're looking next, as well as those transactional spaces like My Pension, is also how we deliver things like newsletters. So members who've been with us several years will remember we used to go through a full print and post glossy production for newsletters. They've since moved into the same document they're held electronically on the website. And we're now taking that to the next step of actually delivering that much more online through the bulk email service, where we'll deliver the sort of the information in a much more easy to access way. And it will allow us to be more targeted about the things we tell you as well. So you won't have to sort of see a big newsletter that might have 20 or 30 things. It might have only 5 or 6 things, but they are particularly relevant to you. So that's a very quick whistle stop along the sort of the digital journey we're going through. So that's me, and thank you very much for your time.
Thank you. Thank you, members.
Yes, thank you all for everyone who's shown an interest today. That's